Hello, guys. Okay, I guess we need to start our session today. And I want you all to mute yourself, please. And I will give like 10 minutes at the end so you can ask questions and we can go deeper into it. Okay, so first of all, I would like to tell you that whenever you would like to learn how to trade, you need to choose for yourself like one pair. For example, the EURUSD, the GBP JPY. So choose one pair, start with one pair. Don't confuse yourself by choosing different pairs and learn all the concepts on one pair. Once you become able to be profitable and understand how to read the market properly, then you can move to more than one pair. And this is the only way. You need to take it like baby steps. We need to start step-by-step process in order for us to build our strategy, our trading plan, and be able to be profitable in the market. Okay, so once you master the pair that you have by backtesting it, okay, maybe on TradingView like I do myself or on FX Replay, you will be able to become more easy on yourself. Like you do not panic, you will become mechanically ready to take any trade or to read any chart. So to start off, I would like to start by the market structure, which is really important by understanding how to move from a time frame to a time frame, how to combine like multi-time frame analysis and how to identify the market trend. So the market moves in three types. It is either an uptrend. Okay, so here we can see that price is moving, creating a high and then retracing into a low. And this low is breaking this high and printing another higher high. And then price retraces back, print another higher low, and then moves up again and create a higher high. This is called an uptrend. And this is when we are bullish in the market. And for us to confirm an uptrend, we need first to understand that we had a low that created a high here, and price retraced, created a higher low, and respected this level. So we don't want to see price moving below this level. Okay, so once this low breaks this high and print a higher high, which is confirmed by a pullback, okay, we will have 4 swing points: a low, a higher high, a higher low, and a higher high. Once we have 4 swing points, now we can confirm that the trend is bullish. Okay, so whenever here, let me just write some. So this is uptrend or bullish. Okay, and here we have a high. Here we have a low. Here we have a higher high. Here we have another higher high. And here we have higher low. Please mute yourself. Okay, so here we have a higher low. So what we can see here is that this low broke this high. And therefore we have a break of structure, the BOF. We have this as well here. Okay, and this is called an uptrend. On another hand, if we flip this to the other side, it will look something like this. And of course, we will have here our break of structure. Another break of structure here. And now what we can see is that we had a high that created a low. After that, this low failed to move above this high and printed a lower high. This lower high was strong enough to break this low and printed a lower low here. And now we are confirmed bearish or downtrend. So here is the bearish or downtrend. Okay, so at this level, what we can see, we see a high that created a low, and then we got a lower high and a lower low, lower high and lower low. So this is an uptrend and we are bullish here, and this is a downtrend and we are bearish. The third type of trends that we can see is the consolidation. It is where price is ranging. Okay, so we have something like this. Okay, I'm gonna draw like a resistance level and a support level just to show you that price is moving inside this range and it is not breaking neither to the upside nor to the downside. So in this level, we can call this a ranging market or consolidation, accumulation, distribution. So either range or ranging market or a consolidation, accumulation or distribution. So the accumulation and distribution are both a consolidation. Okay, it is when price is ranging, but we call it an accumulation when we are buying orders in order to move up, and a distribution when price is consolidating before it sells off. So now what we need to understand is we need to understand that the market usually performs something like this. Up, down, up, down, up, down, up, down, up, down, up, down, up. Okay, so here what we can see is that price created this high from this low, retraced to this level, okay, and then this lower, this higher low broke structure here and printed a higher high. In this case, we don't want to see this low being taken out. So this is like a protected level for us because it was a strong level. So this is a strong low for us that was able to break this high and print a higher high. Of course, now price will be ranging inside this level to this level. So whatever price at the retracement does inside this range, we are still bullish. Why? Because we didn't take this low. So we are protected. This low is protected. So we always want our stop to be maximum below this low. Okay. So once price retraces and then push up again and broke structure at this level, now we have this protected level that we don't want to lose. And this becomes our strong point. Okay, so let me clear this a bit. Good. So this becomes our strong point. Okay, so here is our strong point that we don't want to see price breaking below. And this is our high. So our range is from this high to this low, and price can literally do anything here. Either it breaks this low or this high by a body candle and not a wick. Because in order for us to confirm a break of structure, we need the break to happen by a body candle. So for example, if this is our level here, okay, so let me just change this color to red. Okay, so if here we have a wick and we broke above it by a body candle, this is like a break of structure. While if this was like that, a wick break, this is called a liquidity grab. It is when we grab liquidity and move to the other side. Okay, so we will move to that on a later stage more deeply. But for now, let's stick to the baby steps. So now we got this low that is protected. And this low broke structure again and printed a higher high as well. Retraced to this level and then created a high. So our protected level is here. We don't want to see this low, this strong low, break. Therefore, what we can see here, we can see that this high broke this low. And we got a lower low. So this low is lower than this low. In this case, what we can understand is that this high is a strong high and was able to move price down and break this low. Therefore, now our protected level will become here. We don't want to see this high being taken. And here, at this level, okay, at this level, this is our first sign of market reversal. Okay, bearish, unconfirmed. Why I'm stating that this is unconfirmed? Just because we didn't get this high yet to get our 4 points, 1, 2, 3, and 4. So here, once we got our break of structure again at this low, we have now 1, 2, 3, and 4, and this is our protected level at this stage. So now, here, we are confirmed bearish, and therefore, we can take like a high probability entry at this level here somewhere and target the lows of the structure. So for example, your entry would be something like that. We tap here, we target the low, and we have our high saved by the order block that we will talk about in a later session. Okay, so here is when you have like a high probability and you can take a low risk setup. Because now we are confirmed that we will be moving lower and lower. And therefore, this goes on in this way. Oh my God. Okay. It goes in this way, breaking structure again and again. And what we can see here, we can see that here we had like a trend line. And this trend line is what retail traders use to buy. So for example, they would be entering whenever price taps into this trend line, the second touch, the third touch sometimes, and they put their stop always on the recent swing low whenever they are buying. Okay, so what happens here is that the market is creating an uptrend, and this uptrend is moving on a trend line, and this trend line, we call it liquidity. Why it is liquidity? Because all the stop levels are on this trend line. So let's say a retail trader started, a retail trader, somebody that trades trend lines and support resistance, indicators, Elliott waves, price action that is not deeply into smart money concepts or ICT concepts or something pure based on structure. Okay, so if we look here, we see a low, a higher low, and on the third tap, retail traders will come and put a stop below here, and they will aim for what? They will not be satisfied here. They will aim for the moon. Okay, and what price does is that it keeps on trapping buyers or retailers to take positions, for example, like this, targeting up. So all this trend line will have a lot of stop losses below it. And as a smart money concept, traders like financial institutions, they need to collect these stop losses, because whenever you lose, they make money. This is a zero-sum game. Okay, so somebody needs to lose in order for the other to make money. Therefore, we need to understand how the big money will be moving in the market and not follow trend lines and indicators, because indicators already they lag. They give you the data after forming. So you need to understand the narrative of the market. Price was moving here to the upside. Oh, this low was taken out and this high was respected. We got the retracement and we printed another low. So now we are confirmed bearish. And this high is the protected high that we don't want to see taken out. And price can play whatever it wants inside this range. Therefore, here we can take a safe entry and we can target the lows and target the previous liquidity or previous day high, previous day low, the Asian sessions, the London session, high and low. We can target the monthly high and low, the weekly high and low, the 20 days, the 40 days, the 60 days, the 90 days. There is liquidity everywhere and price moves from liquidity to liquidity. But all we need to know is to create our bias, how price is moving, understand every step, have a clear market read. So we need to start with higher time frames like the daily 4 hours and the 15 minutes, where on the daily we see our bias, the direction of the price. Where are we on the daily? If the daily, for example, is moving up like this, okay, let's say this is the daily, okay? So if this is the daily, okay, this is the daily here, and we know that our daily is moving up, and this structure here is the 4 hours. So we can understand that we are trading with the daily trend. So if the daily is bullish and on the 4 hours we are bullish, we call this a pro trend. And whenever we trade against the daily, even if it was a retracement on the daily, like here, let's say, and we will be moving higher, okay, this is called a counter trend. And as a first step for you guys, you need to start trading with the trend. So you need to see your daily and your 4 hours and your 15 minutes moving in the same direction in order for you to get higher risk to reward ratios and be taking trades safer. Because whenever you trade a pullback, so let's say here, for instance, we had boom, and then price moved to here, and we are bullish. Therefore, we need to understand that at any time, once price return into a discount zone, okay, so a discount zone is, we have this range, and here we have the 50%. The upper level is the premium, and the lower level is the discount. Whenever we need to sell when the price is at premium, and we need to buy once price goes back into discount. And this is applicable not only in trading. For example, if you have a car, if you own a car for $10,000, and somebody come and tell you, hey man, I love your car, I'm gonna buy it for $15,000. You will be so happy to sell it. Why? Because the price is higher than what the market is providing. Therefore, you can collect your 15,000, buy another car at 10,000. But what if your car is $10,000? If your car is like just $10,000 priced in the market, and you find somebody willing to sell his car similar specs than yours at 6,000, you will be so happy to buy it as well, because you know its market price is at 10. So whenever the price is at discount, we look to buy. Whenever the price is at premium, we look to sell. But this all falls within the market higher time frame narrative or bias where we are moving. So in this case, if we're moving up and now we retrace and we hit the 50% in this zone, in the discount zone, at any time, we will be able to see a pullback taking up this high. So this is why always start by looking at your daily. Make sure that your 4 hours is there. Whenever price return into your 4 hours, here you can move to lower time frames to confirm the same change of character and setup. And what we call by a breakout structure is when a low takes a high and print a higher high, or like here, a low takes this high and print a higher high. This is a breakout structure. And or a high that prints a low, create a lower high and break structure. So this is as well a breakout structure. What is a change of character? A change of character is a break structure as well, but it is the first sign of reversal. So we were pushing up here. The first break is called a change of character. This is the first intention that, as I wrote here, this is our first sign of market reversal after this break. And here we are bearish unconfirmed. So I believe that's it for you guys today. If you have any question, please raise your hand and I will unmute you. And I'm ready to hear everything you have. And I want you guys to, and now once this call is finished, I want you to go into the charts and start looking on the chart how the structure is printing. You will be able to do this exercise. So here, I'm gonna map it for you guys quickly so you can just understand what I'm trying to say. Here, we have a high, right? and this high printed this low. Now we need to see this high taken out because this is our protected level. Okay. But what happens? We print another higher high, another higher low, another higher high here. And then we start retracing back into this zone. We take the low, including the wick. Okay, so here price returned into discount. And what do we have here? We have a gap. And by seeing this gap, we can easily see how price reacted to this gap, induced people to start buying. So here, people that had FOMO, the fear of missing out, and decided to buy at these levels, they put their stop here, below the swing, and then price start moving up. What happened here? Price returned, grabbed their stop losses, hunted their stop losses, and delivered higher. Okay, so here you can see how structure was forming. Okay, so you can easily understand how this is working. So you can take any part of any chart. For example, here, what you can see that we have this high and we had this low. Let's start from here. Okay, so this low was taken out by the body candle. So here we got the break of structure. Okay, and then price pulled back again to this level and created another break of structure here. Took out this low. So we have a low here, and this created a new low, and this low printed a high that was as well taken out and printed another low here that was taken out at this level. Okay, and we created a high which is basically here. Okay, but since this high didn't break anything, so we can consider it is at this level. Okay, and we broke structure again. So here we have like this, and now we have this break of structure, this high here, another low at this level. We can call it here. Why? Because here, if you see, we didn't take the inducement. So for us to map structure properly, and this would be given on a later session, okay, we need for price to trace back up. Okay, so for example, here, this low caused this high, this high, sorry, caused this low to be printed. But once we took it internally, like on the same time frame, we were able to print a high here. And then we broke structure here. If you see here, this pullback is not sufficient and it is still in a discount level. So why should price sell from here? Price need to go back into the premium zone for us to see delivery to the downside. Okay, guys, so I'm ready for your questions. Please go ahead.
Yeah, I have a question, please.
Yes, Joseph, go ahead.
Okay, so like when you're trying to like measure your discounts on premium zone, and you know, like when price is moving, it creates so many swing highs and swing lows. So how do you know the ones to connect for you to get a proper measurement of your discounts on premium zones? And also, like after a break of structure, does that mean you have to like draw out a new discount zone again, or you maintain the previous
You will
one?
have a new range. You will have a new range.
You have a new range, right?
Whenever you break.
Okay.
So let me show you. Here, if you are on the daily, let's say, okay, and this is your leg to the upside, okay, and then you have a new leg to the upside. So here we broke structure, okay. So now we are in this range. We are dealing inside this range. So we draw our. So here, for example, you will see price going back, taking the inducement on like internal structure. Okay, and now you confirm that this is your high and this is your low, and this is from where you draw your range or your premium and discount. But to answer your question, this was the first part of your question. The second part is that whenever we retrace and then we create a new range, now this would become your range. from here to here. So whenever a new range is created, your premium and discount will follow as well. Because now we can wait for price to do whatever it wants here until it passes through a discounted zone, print here, change character, retraces, and then deliver higher to take this high and print a break of structure again. I hope I answered your question. If I didn't, please let me know.
Yes, you did. You did. Thank you very much. Well, I still have one more question, please. Can I go
Yes,
ahead?
yes, of course. Go ahead. But because
Okay, yeah. So the next
like
question I want to ask.
yeah.
Okay, I'll be quick about it. Like, how do you know that this is the higher high, so you can start drawing your discount and premium? Because price might just create a high and just keep going higher and higher. So how do you know that okay, this is price is price ready to come back into discounts, so that you can just do your measurement and know that okay, price is going back to discount now?
This is a great.
I don't know if you get the question.
This is a great question. This was supposed to be answered on later stage, but just to show you, I'm going to give you an idea. So if we are on a daily, okay, so here is our daily, okay. And now price is pushing up. Whenever it taps into your daily, you will understand that this high might hold because price returned into a PD array, a premium and discount array, like a zone that is important for price to show any type of reversal, like an FAG, an imbalance, like a breaker block, a mitigation block, rejection block, propulsion block. You have many types of PD arrays, and these should be on higher time frames. So if this is your daily and your swing is coming from, so here, for instance, you had the higher low, sorry, a lower high, and then you printed a lower low, and then you pulled back, you printed a lower high, and now this is your lower low. You know that your range is from this high to this high. And if we break this level like this, price will most probably return into this high and this low now at the 50%, which should be around here, and then continue delivering higher. So what you really need to see or understand is that my bias is bearish and price return to the highest extreme zone where I would love to see price rejecting. And this is where you move to lower time frames and you see a change of character. And then you can confirm after printing 4 swings. 1, 2, 3, 4. You will have an idea because if price breaks above this, therefore this lower high was taken out. Why? Because this lower low was able to take it. And this lower low now is our protected level and we don't want to see it break. So price can retrace to this area here before pushing up again higher. Or else if we break here, we will have a change of character at this level and a change of character at this level. And we will be seeing something like this. Is this clear? Joseph?
Yes, it's clear. Thank you so much. I really understand it. I understand it now.
Yeah.
Thank you very much.
Anytime. Anybody else has any questions?
That's a question.
Yes, please go ahead.
Okay. During the period where the market is retracing, do we just sit down and look at the market retrace, or we could be taking sell orders while it's coming to the buy PY? What do you think?
Well, it all depends on how good of a trader you are, how used to the charts you are. Trading is more into how you see the charts. So, for example, if you're seeing this is your daily time frame, and then I'm gonna be really fast here. Okay, I'm gonna just change color. Okay, so the black one is the daily, and this is the 4 hours. Okay, so now you're seeing price moving down. Okay, can you sell it? Yes, of course you can sell it, but you need to sell it into a zone that was here, like grabbing liquidity from this side and printing a lower low. Can you buy it? Yes, of course you can buy it. Whenever you break this high, you changed character, and then you returned into a zone. Okay, so guys, all of you are asking like a bit of advanced material that was not included in the session. So I'm trying to reply to your questions here, but in fact, I would love if you could help people that are starting now to learn and stick to the material I'm giving, because all this could be covered on later stage or other mentorship sessions, guys. So this is it. Did I reply to your question?
Yeah.
So whenever you can move, you can trade this down, you can trade this up, but you need to understand where to stop here. This is why I would tell you that whenever your market is moving, like the daily is bearish, try to trade with the bearish side. Forget about this for the moment until you grasp all the required data to be able to understand that price will reverse after grabbing, let's say, this liquidity here. So here we had a liquidity grab. So let's say here we had this high that got swapped by a wick, and then you can take your short. But you need to understand that if you're buying here, whenever your target could be maximum at this level, if this level is still within your discount or at equilibrium from your range. So this is more advanced, guys. I prefer to keep them for later sessions, but this is mainly how price will be delivering, and you can trade either sides. Like, it's easy if you grasp. I guess I'm not going to be able to take any more questions because there is 1 minute left. Thank you guys for attending. I hope you enjoyed, and see you on the next one.